Jan Randolph has been following the developments closely. He is head of sovereign risk at IHS Global Insight in London. Jan predicted in December that sovereign risk would be the #1 drag for economies and markets in 2010. And so far, as we all know, he has been right on the money. So, Jan, let's begin with this. Have we turned a corner, or are we simply in the eye of the storm?
We're moving into the next stage. Everyone's waiting and seeing what these bank stress tests will reveal. I think if we look at, I think most investors and banks recognize there are still issues with banks, namely what kind of skeletons there may be on their balance sheets in terms of losses from the original credit crunch or non-performing loans from property exposures. So we've got unnecessary uncertainty leading directly to higher funding costs. You know, the spread in Euribor and to a lesser extent Libor, and that reflects counterparty risk. And until we get the stress test results, it's not going to come down. Okay, you just mentioned Euribor. You know, I would have thought that we would see the pressure come off banks, given the better-than-expected data out of the ECB the other day on short-term loans to European banks. But as this chart we're putting up here shows, it has continued to climb. Why haven't we seen Euribor stabilize the way that we've seen Libor stabilize? Well, I think because we're looking at banks using Euribor, which would be Spanish banks, German banks, and perhaps some others. We simply don't know, but it would be the Eurozone banks as opposed to those that use Libor predominantly. And that's reflective of the problems that certain of these banks might have. And that won't be revealed until the stress test results come out. Jan, I want to turn our attention, though, to a call that you made yesterday, which is that there will be, from the perspective of IHS, some kind of a Greek restructuring in the next couple of years. Greece has been doing everything possible to dismiss the possibility of a restructuring. Why is it that you think it's a certainty? Well, it's a high probability. I wouldn't say anything's a certainty. The IMF, for example, doesn't like the idea of debt restructuring. They see Greece's problems as fiscal and needs to regain competitiveness because their costs went up during the boom years. But I think it is important because it's moral hazard. What we've done here, we've had banks, particularly German banks and French banks, lending to the Greek government, which was essentially risky lending. And by bailing out the banks, it's not so much bailing out Greece, it's bailing out the banks. You're encouraging poor incentives, and really, the commercial banks should be sharing in the burden along with Greek citizens, Greek taxpayers, German taxpayers, and the IMF, which includes US taxpayers. It's a burden-sharing thing, and I think it's for those reasons, moral hazard, that a restructuring will eventually take place over the next 2 years. Jan, who's going to pull the trigger on Greece? I don't think anyone's going to pull the trigger on Greece as such. I mean, the ECB, the Eurogroup, and the IMF will do their utmost to ensure that the Greek government executes the plan, and it has been meeting targets, and they will eventually want to try and turn Greece around, bring it back into the markets rather than it relying on refinancing through the sovereigns, as it were. It's a long, hard slog for Greece, but they, unlike the others, cannot claim to be innocent injured from the credit crunch. A lot of their problems are of their own making or of previous governments, and they've got to deal with that. Jan, thanks for joining us this morning. Jan Randolph of IHS Global Insight.